Hi everyone, welcome to the new lesson in options. And in this lesson, I'm going to go into depth what are options and how can we benefit from them and how can we use them. Well, options are actually a little similar to stocks in the case of when you buy an option, when you're going long in an option, just like stocks, if you're going long in a stock, you wanna sell it higher. So if you go long in an option here and you sold it here, you would make a profit. There's also options where you can short it here in a downtrend, and you can buy it back lower and make a profit too from that difference. So you see, it's actually pretty similar to stocks in that. Now, the only things that differ from it that are pretty different from stocks is that in stocks, actually, which is interesting, is that you can long an option at the top, and if you were incorrect in the direction and the price went down, you wouldn't lose money. Actually, you might in some scenarios win money. In some situations, if the price is going down and you went long towards a rally, when you went up too late and the price went down, you could actually end up losing nothing, possibly making a profit too. And the same case can be said that you can even make money when the price is moving just by a dollar. So it's going up and down by a dollar, like it's done this for a few months. You could still even make money doing that, regardless of wherever the direction the price goes. Now, I want you guys to hold your horses here, because many of you guys are going like, wait, what? How is that even possible? You're saying that if I go long here and the price goes down to here, I still make money? Yes, but don't just be, completely like that's don't be completely convinced that it's like that necessarily. There's some scenarios where yes and no, because if it really was like that completely, everyone would be doing options. Okay, and this is majority of the reason why people lose money, which you guys will see. But you can make money still if the price goes down or up or wherever it goes. So as you see here, if the stock that I bought on this level, let's say I went long in an option here, and my anticipated price above was that I thought the price would go up by $4. But let's say it only went up by $1. It went up, but then it just stayed there, and then it started to do a reversal and went down by a dollar, less than when I entered. I would still make money in that scenario. Same thing could be said if the price went up by a dollar and then went down to the my entry, and then it just stayed with same highs and same lows. I would still make money in that lateral trend or consolidation trend. What about in another scenario where if the price goes up, doesn't hit the anticipated price that I wanted, but goes up by $2, I would still make more money still. And of course, if the price goes above my anticipated price, which is $4, and goes up to $6, I would make even more money. So that sounds great, right? Like you could make money in any scenario. Same could be said in when you're going short. When you go short in a downtrend, right? And let's say you decided to go short here, but the price went up. You were shorting for let's say $2, but the price went up by $3. So it went up a dollar more than your entry. You would still make money, even if your anticipated profit was that the price was going to go down by $4. You would still make money in that shorting, which you could say that they made higher highs and higher lows. What about if you shorted in this downtrend and it decided to do a lateral trend where it did the same highs and same lows? You would still make money in that too, even if your anticipated profit target was at $4 less. What if the price goes up and down? So you shorted here and the price went down to $3 but not $4. You would make money more. And lastly, if the price went down more than $4 to $6, well, you'd make even more money. Okay, so let's really look at this, right? I'm pretty sure a lot of you have caught your eye on this, because a lot of you might be very confused, just probably thinking like, where have I been? Why have I not heard of options? Hold your horses. It's not, there's a game to a lot of this, right? You will understand. So options is a very technical game. You know, in a stock, if you decided to go long in a stock, you just need the price to go up no matter how long it takes. So let's say that this took a month, right? In a stock, you were going long in Apple, and the stock went up by $10. Well, you make a profit of $10 per share. We all understand that. But in options, it's pretty different. If you go long in an option, your trade benefits like a stock if it goes up, but the catch is that you need it to go up in less than a month here. As you see, even though the price went up to your profit target of $10, but because it took a month to eat your price, which was after a date you wanted it, your option lost a lot of its value already, and mostly by now lost all its value besides intrinsically. Which most likely you will break even at your profit target. You guys understand what I mean intrinsically and different values that I'll talk about. I want to tell you that 98% of people, and this is very true, I think it's even more than that. I think it's 99%. This is why not much people do options. And you will see why, especially from my technical explanations and fundamental areas revolving options. But about 98% of everyone in options fail and lose money because options is a very technical game. It's all based by numbers and its statistics, not just buying for the sake of buying because you think the stock is going to go up. You need to make sure to buy things in options that is correlated realistically with the stock can do and benefit on the long term, not just the money that you can make on a lot while that can happen, but that's always short term. And the losing streaks will come and it will wipe out your gains previously from buying the incorrect options, strike prices, prices, stocks, statistics on options, and so much more. As you see, options are more convoluted than stocks and any other financial instrument that there exists today. They're in their nature more volatile and riskier if you don't use them responsibly, but they give out incredible returns if you really understand them and utilize them correctly on what the option can actually do based on direction, not on guesses but by numbers and statistics. They always react the same, which is different from stocks because in stocks you never see a movement of the same price. Like you never see maybe in a week there was a movement of $5 and then last week there would be a movement of exactly $5. No, there might be a movement in stocks like a movement of $5 and then the last week it was $4.80. You're never going to really see prices move the exact same amount as they were in the past. But in options it's different. They are separated strikes that move at the same rate every time by statistical measures in them that are affected by what's happening to options prior to the stock. So you guys, that may sound a bit technical, and a lot of you might be a bit confused, but options are literally based on statistics and numbers. They're not guessing. It's not like a guesswork in stocks where you go, the stock moves up by $10, you make a profit of $10. There's statistics involving into that, but that statistics is actually advantageous to people like me because I understand options. So in a way, it makes it more predictable because I'm able to find out the ratio of the gains and losses that can produce the option itself to what the stock can do. So the way how I do that is knowing the fundamentals and knowing the type of prices that I'll look in options, and a lot of things revolving with the stock itself, which you guys will learn in the lessons in here. But there's a lot of when you understand it correctly, you will become that 1% that will understand this, and the rest of people don't. So a common mistake everyone does in options, which I could tell you, I've been trading options. In fact, I actually started doing options. It was the first thing I did when I got into the stock market. So I have a lot of experience in options. It's one of the instruments that I would say I have more experience in because I've done it the longest. But what I can tell you is a common mistake everyone does in options is they guess on prices based on results, what they've done recently in the option, to then do it again, which makes them biased to that option with the same order types and they're not aware why suddenly their options are losing value to trades they did compared to before. Well, that's because in options, an option is made by a statistical measure. It can move exactly what scenario the stock can do, whether the stock moves up or down. It will move to that calculations. So they're literally like loss because options are based on by calculations and other factors of what that calculation is made up by the value. So you can say that they're in their nature like loss. They won't change, but adapt on what comes, which can be on what comes to the stock, which can be expected if you have your mentality and analysis right, which makes it beneficial to us because they're predictable on what other prices can move, which we base our trade in. This is what everyone doesn't do and loses a lot of money in options and stays away from it, which honestly, frankly, is better for us since we profit from those who are impatient and bought or sold incorrectly. Then there's some people who think they can beat, I think a lot of people, I know so many people that do this, that there are some people who think that they can beat everyone in options and can do it on their own and find a thin line in between options that they could find the trick about it and learn a lot of money without knowing the actual laws that move it and get greedy. And these people, I guarantee you, they lose money every single time. And if not, they will lose money for sure. Well, welcome to options and the stock market because that's literally what it is. What in the world are options then? Well, an option is a financial stock derivative that lets you buy a contract that emulates the stock movement with its price on contract. The contract will be worth 100 shares of the stock. If you buy one contract, let's say a call of Microsoft, you are trading 100 shares of the stock. However, the contract price to hold the contract will not cost you what it is to hold 100 shares. It's going to cost you the difference or the spread of the current share price, which is the spot price, by the strike price you're buying the contract in. So let's say the spot price of Microsoft is at $200, but you decided to buy a call option at the strike price of $201 for one contract. This is going to cost you $1 because the strike price is $201 and the current share price is at $200. So if you take the difference between $201 and $200, that's already $1. But because remember what I told you, that in options, every contract per contract is 100 shares. So if you buy one contract is equivalent to 100 shares. So if what your contract costs is $1, that means $1 times 100 shares will be $100, plus added by the amount of time value and volatility you have in the option, which will be a little more if you have that value still. I know that sounds a bit complicated, what I said at the end, but for right now, I just want you guys to focus on the intrinsic value. That's the intrinsic value. The intrinsic value is literally the difference between your strike price and your spot price. If your strike price is at $207 and your current spot price is $207, if your current strike price is at $201 and your spot price is at $200, that contract is going to cost you $100 added by, it's just going to be $100 by the intrinsic value. That's called intrinsic value. It's the difference between in the share price of your strike compared to the current price it's in. So another way of saying, if the spot price right now was actually above your strike, you would actually be making money. I'll talk about that in a bit. For right now, I just want you to focus on the intrinsic value, which is the spot price difference from the strike times 100 shares per contract will give you the cost for the option. Because you're buying the privilege. So what I want you to know as well is that because you're buying the privilege to own 100 shares at the strike price, it's not even in the share price yet in, which means you're buying it cheaper, if you think about it, to own 100 shares on that price or sell it, which makes you hold a contract and eventually pay a little to own the entire value of asset from a specific movement on stock to make a gain. Options are viewed, for some of you who don't know this, and really this is the way how it was created, options are viewed as at least for clearinghouses or brokers, they view it as, they think you're going to use options to eventually own a lot of shares, which you can, but at least in trading them, you're not really doing this. You're just buying cheaper and selling it to someone else for a higher price. And when you're selling, well, obviously you're going to be selling higher at another person, and that person will buy at that price to benefit. And when the value comes down, when the value goes down and that person has to pay you the amount because it went worthless, you get to keep the premium or the cost of the price you sold it. These are options. You guys will explain. You guys will understand later in depth in the few upcoming slides, like what sort of terminologies and what because I think a lot of people, when they hear me talk about this, is sort of like a different language. You guys will understand a bit what I'm talking about here. So, but I wanted you guys to understand what are options. Again, options are a derivative from a stock that lets you emulate a stock movement by ordering a contract. But a contract is worth 100 shares. So if you buy one contract and the contract costs $1, it's going to cost you $100 because it's 100 shares. It's equivalent to 100 shares. That's all you need to know for right now. So in options, there exist only two different type of options, and it's calls and puts. However, in options, there's actually three directions you could take, which is upward, lateral, and downward in your direction of what you want the option to be. So lateral is actually formed by a mix of upward and downward options to make it beneficial on sideways movements. So as you see here, when you buy a call option, when you buy it, what you're saying is that you're going long in the option. You want the price to go up in order to benefit. In order for the call option to benefit, the price has to go up, similar to if you went long in a stock. In a put option, it's similar to shorting a stock, where you're buying the put option in order to benefit when the price goes down. So let's say that your strike price was at $300 and it costed you $100, and the strike price that you're in the strike price was $300, but now the current spot price is $301. So what that means is that you guys will understand these sort of terminologies within the next video, but they're called in the money options. Whenever your spot price in put options are above your strike price, those strike prices are called in the money. So whenever your option's in the money and it moves by $1 difference, that means if yesterday the current price was at $300 and it went down to $299. And if you bought a strike at $300, your strike price at $300 is now a dollar difference to the spot price. That means you're gaining $100 just as if you were doing 100 shares if you bought one contract. That's a put, and that's the same thing what goes on with a call within the money. In this case, it's the reverse. If the call option, if you bought at $300, or let's say in this case you won't confuse the put, if you bought at $100 of a strike price and you bought it for $100, for the strike price, let's say if it was $150 and it costed you $100, and let's say the strike price went up by $155. Well, now there's a difference of $5 between your strike. That means that you made $500 now in that, just with $100. Now, how do you get a lateral position? Well, it's a mix between the call and put. That's what it is. A call and put mixed, like some sort of strategies. It doesn't mean that you buy both, but in mix, well, no, it does. In mix, you get a neutral direction for the trade. So if the trade stays neutral or lateral, you get to benefit from that. So I wanted you guys to understand the sort of relationship on calls and puts and how they work. So what the heck is a call? Well, to really go down with it, a call is a contract option that benefits and increases in value when the stock goes up, as it's a contract between the buyer and seller to purchase the stock at a certain price up until a defined expiration date. To understand this, the buyer, which in this case, let's say if you bought a call, you have the right or option, not the obligation, to own 100 shares of the stock if it's been exercised or assigned. So the word exercised or assigned basically means it's a way of saying that when your option has been exercised or assigned, it means that if your option was expired in the money. So remember that in options, for some of you who don't know, options have expiration dates, which I'll talk about. That's what I said before, that you need to, when I said like a month, like the price went up by $10, but it already went up to $10, but and it took it a month and your expiration was in a month, you would lose money. In this case, let's say you did an expiration date for 1 month from now. So right now it's November 18. Let's say if I decided to do, if I decided to buy a call option that expired on December 18, which is exactly a month from now. And let's say I was also waiting for the price to go up to $10, but it didn't go up to $10, and it actually hit my strike price, but right at the expiration date, and I let that option expire. If it goes above my, if the price went above my strike, so let's say in this case I decided to buy a strike price of $310, but let's say the price ended at the expiration date at $312, and I didn't decide to sell that. What the broker's going to think is, because remember that options are derivatives of a stock. They're sort of a byproduct from a stock that lets you own 100 shares of the stock from just owning one contract by paying a little debit. But when you let an option expire worthless in the money, which if you guys remember what in the money means, it means that if my strike price was at $310 and the stock went up to $312, which is $2 above, or at least if it's above the strike price, even if it's $1.50, then my option, if I let it expire, which means if I don't sell it before the market closes on that day, the next day I'm going to be assigned, which means the broker is going to tell me to buy 100 shares of the stock. So in this case, if the stock costed $310 because I bought it at $310, I would have to buy an equivalent of buying power, $31,000. So don't let that happen if you don't have $31,000 and if you don't even intend to do that. But again, keep in mind that this only happens if you let the option expire in the money. And you guys will understand why this is even a thing. So now a seller, on the other hand, of a call has the obligation, not the right, to own those 100 shares if the stock's been exercised, which again only happens if you let the option expire worthless. In this case, not even in the money, you just let it expire at any level. Actually, no, if you let it expire in the money. So just in a depth of explanation. So let me give you an example here. If the call you bought was out of the money, so out of the money means if you bought a contract of, let's say, Adobe, and the current price on Adobe is $400, right? And let's say you decided to buy a call option strike price of 300 and, or no, sorry, $405, which is $5 above your current share price. Let's say that that out of itself is already out of the money. Why? Because when a strike price is in this case in calls, not in puts, just in calls. When a call strike price, which is $405, is whenever the strike is above the spot, which means in this case because it's above $5, that means that it's out of the money. When it's out of the money, you can let it expire because when you sell a call, which I'll explain this in a better depth when I talk about selling calls, when you sell a call, what you're doing is you're selling to another person that call, and when you sell that person that call, he's going to buy you. So he's going to buy that call. So what you're doing is that you're going to collect premium. It's called premium. Premium just means the price of the contract. It's just referred to as a premium. If you when you're a seller, you're actually collecting. You're actually credit. That's called a credit. When you're crediting the premium, it means that you're the seller and you're going to benefit from the price expiring. Because when you want to remember, when you're a seller, you always want to sell high and buy low. But the best thing you can do as a seller is when you sell high and the price absolutely falls down on its ass and it expires worthless. Why? Because the buyer lost all the worth of, because both of you are really betting on where the direction's going. And if the buyer lost the bet because obviously the option that he bought expired worthless, which means he lost the money of the option, that money that he lost goes to you because you sold him that. But when you buy an option, of course, you want the option price to increase in value. When it increases in value and you close the option, then the seller has to pay you that amount. Now, a lot of you might be saying like, wait, so what happens if a seller doesn't give me the amount? No, that's not how options work. You're not even, you can't even do that, first of all. Whenever you sell it, so like this stuff is extremely safe, that whenever you're a seller of an option, you also have to have a margin account because you're lending in a way like similar to shorts. You're able to collect, you're lending into someone. So you need to have you need to have more capital that shows trust towards the broker. But let's go back to the example. If the call you bought was out of the money and it expired in the money, you keep the premium in from the price it expired from. Compared to when you bought it, as the broker will assign you 100 shares at the price of the strike price. So obviously, if the strike is in the money, that means the spot price is above the strike price, which lets you buy Microsoft at $301 from the strike when it's now already $305. So what you're doing here is that you're buying it cheaper while also gaining that increase in the option itself to win it up by $4 in the stock. So the option goes up by $400, like if you're owning 100 shares, of course, with one contract, which net not only is the price higher than what you bought it before because you bought it at $301 when it's already now $305, but because the broker let you buy those 100 shares at a lower price than what the stock is, then you only had to pay $30,000 and $100 compared to $30,000 and $500. And you also benefited from that $4 increase from 301 to 5, which is $4, which in options they paid you $400, like if you were owning 100 shares. But with options, you would just be paying $100 compared to buying the stock, which would have costed you $30,000 in order to get a gain similar to the 100 shares, or at least a big return that you really can't get on stocks throughout certain movements. So then what's the max you can lose in an option? Well, your max risk is always going to be the max buying power you put in. For example, if you buy Microsoft at $1, that's going to be $100. So the max you can lose here is $100. Even if the stock falls 50% of where it's at, you are still going to lose $100 no matter how bad the price went against your trade. Because you just need to pay what the seller let you pay for the contract. And that's $1, which is equivalent to 100 shares. I mean, $100. Now, this is great because in options, you really have limited risk in unlimited gain or infinite gain, since you can win as much as you want, like a stock can go. But rather with the stock, if the stock was at $300 but drops to $150, the contract you bought will only lose $100. But with stocks, if the stock fell from 50% from $300 and you bought 100 shares, you could have lost $15,000. So now you guys see exactly why I mean about that. You see that though why almost everyone in options loses money, because when the stock in three different values don't go in their favor, the option contract, no matter if the price went up, those other two values got destroyed and lost all their premium left in the contract, which is why everyone thinks options is risky. It is if you don't know what you're doing, just like driving a car and you don't know how to drive a car, and buying junk that statistically you can see on measure that if the stock moves up on the contract, it will be worthless or it will not be worthless. But a lot of people don't do this because one, either they don't do their due diligence because they're lazy, or two, they don't know and get scared or overwhelmed and bounce to another instrument they think they can make money on. So I want you guys to really pay attention to this. This is called a P&L graph. So a P&L graph. So this is the call options. This is the calls P&L graph. You guys might look at this and be like, "What the hell is this?" Well, I'll explain. So what you need to know right now is, so let me explain a few of the things in here. So this is called the y-axis. This is basically the money that can be made in this particular call option, which you can see right here. It's when it loses money, and right here it's when it wins money. Okay, just know about that. The y-axis, that's all it is. It just shows you the amount of money the current option can make, or the amount it can lose. Now, if you look at this green line represents the P&L of the P&L at the expiration date. So what does that mean? Well, we know that in this example, I said that I was buying Microsoft a call option strike price of 306, and I entered it on, let's say, November 18, and it expires next week on November 25th, which is 7 days. And the current price right now is at $301. You can see that there's a difference of $5. But let's say usually, which I'll explain later lesson, the reason why this costs $100 is because, so you guys can understand, intrinsic value. So whenever the call option is in the money, if you guys remember what's in the money, it's when the strike is above the spot price. When the strike price is in the money, the valuation within the contract itself is added by a little bit of theta, but most of all intrinsic value. However, you guys would think like when I told you if the intrinsic value in an option is the difference from strike and spot price, yes, if it's in the money. However, if it's out of the money, there is no intrinsic value. There's only extrinsic value, which you guys will learn about, which is theta. There's only extrinsic value. And that's just important to understand. So just keep that in mind, that intrinsic value is not factored in whenever it's out of the money. What's out of the money? Whenever, for example, I said that the spot price is $301. However, my call strike is at 306. The strike is not at this price, or the spot price is not above the strike. So the strike is actually above the spot, which means that this strike is out of the money, which means that the only valuation the strike has is not intrinsically, or else intrinsically it would have costed $500 here, which in reality it's not. It's actually costing $100 because it only has extrinsic value, which is factored in by time and by volatility. What's the time? Time value represents the expiration, the amount of time left on the option itself. So what's the time? Well, it's between the date right now, which let's say we're looking at November 18, between the expiration, which is November 25th. This is your time value. Volatility, which I'll explain a bit further, is sort of like a cyclical part. It's similar to seasons where it could somewhat affect option prices to be expensive or not. In this example, I'm going to try to keep it basic. I said it was $100, but what I want you to understand is the green line here is the expiration P&L of the option. So what does that mean? If this is what we're looking at here is the call strike of 306. Okay, just think about that. It's 306, and this green line represents November 25th of what that contract would look like at November 25th. So if you see here, as I remembered, when a call expires, the only valuation left, obviously because it expires, it doesn't have any time left, and it doesn't have any volatility, which is extrinsic value. The only thing it has is intrinsic value. The intrinsic value is similar to the stock. So if I bought the strike at $306 and the price went to $306 at expiration, what happens here? I'm going to lose $100. How do I know if I'm losing $100? Well, in the profit and loss graph, if you see the green line below the $0, which is always going to be there, if you see it below if you see it below the break even, this is called the break even line. This is what your contract will cost, and this is your max risk, and this is why I talk about limited risk. Now I want you to pay attention to this line. You can see that these lines look like check marks. If you look at this line, it represents that if the price goes up to $307, you would make money. You can see that if it went up to $307 all the way to $311 at expiration, you would make $500. Why? Because intrinsically, you would be making a $5 difference, which by 100 shares per contract, that's if you buy one contract, you're making $500. So we got that, right? This is very important because this is a great way in order to analyze if the option is a good deal or not. And I do this every single time I look at options. So again, what's this green line? The green line, remember, it's the profit and loss of the expiration date. This green line represents November 25th. It represents what the option is going to do in the stock, wherever price it goes. So what do I mean by wherever price? Well, I'm going to talk about this now. This is called the x-axis share prices. You can see here that the share price, as I said, the spot price currently is at $301. Well, $301 is right here. Anything from the left, which is always going to be like that, anything from the left of the spot price will always be share prices below the spot price. Anything to the right are share prices above the spot price, which could be, yeah, that's how it would be. Now, what are the what's this purple line? Well, this purple line is the profit and loss line of November 18, or because this you can do in certain softwares. Let's say if you were looking in Thinkorswim, you're allowed to enter a certain date. So let's say I decided to keep it at November 18. This is going to represent the profit and loss of this strike price, the call strike price, of what it costs. Is going to represent how that option would gain no matter how far the price went up or how far the price went down, and how the option would behave as time passes on. So you could see here that if you understood the y-axis, well, you can see here that if you look at this carefully, I separated each of the share price by $5 to make it a bit simpler. But if we kind of like generalize it, if we look at this price right here, which is, if you look at $500, these green lines represent that number. So this would be $500, this would be $1,000, this would be $1,500, this would be actually $2,000. I made a mistake there. Yeah, my bad, guys. Yeah, this would be $2,000. This would be 25. This would be 3. This would be 35, and this would be 4,000. Okay, well, if you see here though, that you can see that by today only, even if we know that the current price right now is at 301, but let's say that the price today went up all the way to 300, and let's say that looks like it's 308. Let's say if the price went up by basically $7, because it was at 301 and it went up to 308, that's about $7 increase. Your option now would be worth $500. Okay, it would be worth $500. If it went up to 311, you could see that it goes. You would be worth $1,000. And this profit, if it went up to 321, you could see that it goes up to $2,000. No matter how far the option goes up in a period of time, your call option is going to go up unlimited, like it's infinitely. It doesn't have a limit. However, how far the price goes down against your trade, you're only going to lose $100. Okay, so I just want you guys to understand this. I'll explain a bit more advanced maybe in upcoming lessons, but what I want you to understand is this, because this is very important. If you understand this, you will be a step ahead from a lot of people. Like a lot of people I know. Like there's a lot of people that I know that have done options for 3 to 4 years and they don't even know this graph. So if you guys, why? Because they've learned throughout results, but not by statistically what an option moves. This is by statistically. This shows you what the option does, no matter what a person tells you. It's facts. If the option moves, if we see that if the option moves from $301 to $308, you're gonna make $500. If it goes up to $301 to $311, you're gonna make $1,000. It's that simple. Now, this is very generalized. You're actually gonna make, I'm pretty sure, much more than this, just because. Remember, because you have still time left to your expiration, you're gonna make a bit more than $1,000 because you have extrinsic value. An option is made up by 3 values, which I'll talk about. It's extrinsic, it's intrinsic, and it's implied volatility. You guys will understand that's it's volatility, but it's made up by extrinsic value, which brings the price up further. However, if you look at the expiration at $308, you're making maybe $100 compared to $500, which you could say is going to cost you actually about so a very important thing to understand. So remember when I said that the call strike price was 306? Well, if you look at this graph, you could see that when the graph starts changing and going up to gain in value, you can see that it starts changing at 306. Well, that's because that's your strike price. That's always going to be like that. However, you might be saying, then why is it that when my call option gets to the strike price, I'm losing money at the expiration? Well, that's because in call options, you always pay a premium, right? Whatever the premium cost, let's say it costed you $1. Remember, $1 is $100. That means that your premium is going to be added by your strike price. Why is that? Well, because remember that in call option in options, they're made by derivatives of holding a lot of shares. So remember that I said that, if you were to buy call option like the way how brokers think you are, whenever your option expires, the only value left in an option at an expiration date is only intrinsic value, which means that if the stock moves by $1, the option, if it's in the money, not out of the money, if it's out of the money, that option is worthless. But if it's in the money, which means that if the strike price that you bought at is below the current spot price, which means that the spot price is above the strike price, that means that the only value you have there is what the stock can move. So if the stock moved $2 from $306, that means it's at $308. If you will have the contract to be worth $200. Now, it will be worth $200. That's important because if you let the option expire worthless in the money, the broker's going to get you assigned 100 shares. He's going to assign you 100 shares at the $306 price of the stock, which means that you're going to be assigned $30,000 and $600. But because the stock right now is costing $308, which you should be making a profit of $2, you will get back $200. However, this doesn't mean that you made a return of $100 and another $100. No, with contracts and options, they're based on prices. So if let's say, I'm going to give you an example. Let's say, and this is actually a perfect example. Let's say the current price right now is at $301. And the price went up to $306, and it took all the way up to the expiration to do that. But let's say it went to $307. Well, because it went up to $307, maybe it's a little bit above, like 307.20 or 307.30. The only value you only have in that option is what the difference of the only value of that option is going to be what the difference of the spot and strike is, which is intrinsic value. In this case, if it's $1 difference, you're going to have the option costing a premium of $100. But because you bought the premium at $100, what that means is you're breaking even. Okay, but if it went up to $308, you made $100 profit, which means you made 100% ROI. Okay, so now you understand that, because that's important to understand, because a lot of people don't understand that they think that if their strike price is at $306, their break even is going to be at the strike price. No, that doesn't mean that. Your premium is always going to be added by what the strike price is. If your premium is $300, you're going to have to add $3 by whatever the strike price was, which let's say if it was 306, your break even is then going to be at 309.